Come to what is a green shoe option again. Now I have explained you the procedure and the logic of it. It will be easier for you to understand. It's an over allotment mechanism. One example I had shown you where the company ended up allotting 1,05,000 shares. Many times it may not be over allotment, because suppose the stabilizing agent purchases entire 15,000 share, then company will not have to issue more shares in that case. Green shoe option is an option to allocate shares in excess of the shares which have already been issued to the public. What is the objective of green shoe option? Price stability mechanism, to provide post-listing price stability of an initial public offering, because it has been observed that prices can be very volatile, as either there can be too much of demand or too much of supply pressure after the listing. To create the confidence of the investor, to maintain the reputation of the company, this mechanism is used, because if the price falls, the reputation of company is at stake. The process of green shoe will be explained with the help of following example. If a company is issuing 1 lakh share, the company will enter into an agreement regarding over allotment option. So actually it is called over allotment option, but now it is popular as green shoe option, with one of the stabilizing agent, who are mostly the underwriters, to the extent of 15,000 share. So as per SEBI, you can only use 15% of the issue. According to the agreement, the promoters would lend 15,000 share to the stabilizing agent for a limited period of 30 days from the date of listing. Underline, this facility is only for 30 days and it is 15% of the issue size. So these are some numbers which you will have to remember. So allotment will be made to the extent of 1,15,000 share. 1 lakh shares issued by the company and 15,000 share borrowed from the promoters. On listing, if the market price falls below the issue price, now keep my example in mind and read this sentence. If the market price falls below the issue price, we have assumed issue price is say 100 rupees and market price is 90 rupees. The stabilizing agent may buy shares from the market to the extent of 15,000 shares. To the extent of 15,000 share he will buy, not more than that. This will help to increase the market price of the share. Why market price of the share will increase? Because demand will be created by reducing the selling pressure. The shares purchased by the stabilizing agent will be then returned to the promoters. So only 1 lakh shares remain listed on the stock exchange after 30 days. Now this paragraph is applicable assuming that the stabilizing agent purchases 15,000 shares. Then the number of shares will not increase. However, on listing, if the share price rises and the stabilizing agent doesn't buy share from the market, then at the end of 30 days the over allotment option is exercised. Now he does not have share to return it back to the promoter. So then the company will allot 15,000 more shares, which are then returned to the promoter. So in that case, the total number of shares that will get issued will become 1,15,000. So therefore it is called over allotment mechanism. The company ended up issuing more shares in case if the share price rises. Your note does not discuss what if it does not buy entire 15,000 share but only buys less than 15,000 share. So in that case the differential share will be issued by the company, and if there is any balance left in that GSO bank account, that will go to investor education fund. Okay, now do you want to draw this diagram or just understand? Draw. you want to draw, then you have to write little fast because it's long discussion. Same thing has been presented in the form of a diagram also. This institute does not have in their material. Huh? Can you give us the print? Okay. Okay, I'll give you the print. Don't write, just understand. The IPO issuer company appoints one of the book runner as stabilizing agent. The stabilizing agent borrows from promoter or the pre-issue shareholder or both up to maximum of 15% of issue size, which are kept in a new GSO demat account. This 15,000 will be kept in a separate GSO demat account. There is a new GSO bank account. I had drawn two accounts if you remember. One for demat, one for bank. In bank account, money will be kept. In demat account, shares will be kept. Created for the execution of this greenshoe option program. Post listing of share on the exchange. Left side. In case of downturn in the share price, post listing, the agent buys share from the market to the maximum of over allotted share, means 15,000, to ensure prices does not fall below the issue price. The money is utilized from the GSO bank account and the shares are deposited in the GSO demat account. In case of excessive demand post listing, that is, if the share price rise after listing, the agent is not required to stabilize the prices. So here he will not purchase the share. At the end of that 30 days period, which is GSO period, if stabilizing agent is able to buy share equal to the amount of share borrowed from the promoter, it returns them to the promoter. So if the GSO demat account has 15,000 share, it will be returned to the promoter. If the stabilizing agent is unable to buy share borrowed from the promoter, in our example I said 10,000 he has purchased from the market, 5,000 he could not. Within the stipulated period and there is a shortfall, new shares are issued by the issuer company and they are credited to the GSO demat account and then returned to the promoter in lieu of the share borrowed. So in this situation, the over allotment will be there. So this is greenshoe option. It is an option. Student had asked me a query in the break. Is it compulsory? The name itself is option. If it is option, means it is not compulsory. Next paragraph in your book. The greenshoe option acts as a price stabilizing mechanism. Further, over allotment options are known as greenshoe options because in 1919, long back, Greenshoe Manufacturing Company, this was the name. Now it is a part of a Wolverine Worldwide Inc., which was the first to issue this type of option. A greenshoe option can provide additional price stability to a security issue because the underwriter has the ability to increase supply and smooth out the price fluctuation. It is the only type of price stabilization mechanism measure permitted by the stock SEC in US. So this facility is also there in US market. Okay. Then SEBI. SEBI follows SEC. Okay. Whatever happens in SEC, SEBI also tries to follow that. So it has also introduced in the Indian capital market. In which year it was introduced? 2003. And there is a circular which they have issued, SEBI, CFD, DIL, DIP, circular number 11. This you don't have to remember. Maybe at the most year 2003 was an year when in Indian capital market greenshoe option was introduced. And since then a number of companies have implemented greenshoe option. Now see, the institute have asked one question from you. ABC Limited issues 15 lakh share of ₹100 each. Greenshoe option was exercised by the company prior to the issue. Okay, so this has to be mentioned in the prospectus that this issue is subject to greenshoe option up to 15% or up to whatever percentage, but it can't be more than 15%. After listing, the share price plunges to 90 rupees. Will the stabilizing agent buy the share from the market? Yes. Decided to buy the share from the market. We should ask the question, will the stabilizing agent buy the share from the market? Student will write yes. Next question they will ask you in your case study, how many share he can purchase? That they have asked to arrest the fall in the share prices. 15% of 15 lakh share. How much is that? 15% of 15 lakh? I think the answer is printed in your book. Just check. Is it correct? 2 lakh 25,000 share maximum you can purchase. This is the information that is given in your ICI material. On green shoe option, I think that is enough. Now, there is a concept of anchor investor, and which was also introduced by SEBI in the year 2009. In which year the concept of anchor investor was introduced? 2000, not 2003. You can see somewhere below. Now, what do you mean by this word anchor? Have you heard this word anchor? When did you hear it for the first time in your ship? How it is connected to a ship? They anchor the ship to the port so that the ship is there in the port only. It does not run away on its own. Yes or no? Whenever any TV program takes place, I know from there is an anchor. In Kaun Banega Karodpati, who is the anchor? Amitabh Bachchan. Okay. In Big Boss, who is the anchor? Salman Khan. So if there is an anchor, and if the anchor is good, it creates confidence. Anchor brings stability. Okay. And when there is an anchor who is qualified, educated, knowledgeable, who has an experience in that field, it creates confidence in other stakeholders also. Okay, same logic is applied in the IPOs also nowadays. So what is an anchor investor? Question in the exam. Anchor investors will be QIBs, not individuals. Now why they have chosen QIB to act as anchor investor? Because they have the expertise. Okay, they have the team of people who know what is the worth of a company. Is it a good company? What should be the value of the shares? Whether it is worth investing. So that is why QIBs. And they have a lot of money also. Yes or no? They have a lot of money. Because you need to invest money immediately a day before the IPO. Who purchases share one day before the IPO opens? So companies can go for anchor investor also. They help in arriving at a fair price and instill the confidence in the minds of the investor. The reason is that these are very reputed agencies, very reputed companies. So if they are investing in the company, that news will go to the public because it is one day before the IPO opens. And therefore the public will also be keen on investing in that company's shares. As the name suggests, they are supposed to anchor the issue by agreeing to subscribe to shares at a fixed price. That means they will also purchase in that price band only, so that other investor may know that there is a demand for the shares offered. Basically, the idea is to increase the confidence in the investor community that there is an anchor investor behind this issue. Okay. And they have also invested their money. Let us also invest. This concept was introduced by SEBI in June 2009. to enhance issuing company's ability to sell the issue. Okay. Which was the first company which used this anchor investor facility? The Adani Power. Okay. So this is a general knowledge question. First company to use anchor investor is Adani Power in 2009. Okay. Now you are a student of finance and capital market. For everything you should know why this is done. Wherever you can find out why anchor investors are important. So many companies have a complex structure and are not necessarily profitable at the net level. Complex structure means companies operate through various group companies. They may have subsidiary, joint venture, associate, and it is very difficult to assess their profitability. Okay. So who are the people who are able to analyze such complex structure? These anchor investors. These are basically institutions. They have a team of professionally qualified people, trained people who can understand the business model, the valuation, the structure, and they will understand that yes, this project or this share is worth so much. Other investors can't. Okay, because companies now have complicated legal and business structure. So some of the examples are where these anchor investors are used. Sadbhav Infrastructure Project, Ad Labs Entertainment, Cafe Coffee Day. In such cases, anchor investor can guide the other investor. So basically, they are like somebody whom you can look upon, okay, as a person who knows the business. An anchor investor also invests his own money. He is not just there as an advisor or a consultant. He has to put his own money in the company. So his own skin is in the game. Technically, he has to invest his own money in the company. So therefore, anchor investors have their own skin in the game. So they are also having a stake. Their money is invested. So of course they just can't take decisions without doing the proper homework. Right? They have actually subscribed to the shares at the published prices. And they purchase huge number of shares. So lot of money, crores of rupees are invested. As the anchor portion of an issue is usually taken up by serious institutions. Serious investors are there because huge amount of money is involved. Thousands of crores of rupees can be involved depending upon the size of the issue, such as mutual fund, insurance company, foreign funds. Their valuation signals can be useful. If the issue has problems, say of corporate governance, this anchor investor will do lot of homework, lot of research on the company before they open their purse or ask for a steep price. Some companies want a heavy premium. The anchor investor will say, no, sorry, I don't want to invest. We don't want to invest. So it will get a tepid response, means very subdued response, low response from the investor. And then what the company will have to do? Company will have to reduce its price. Because then if anchor investor is refusing to buy, it will send a wrong signal in the market. Am I right? If tomorrow Salman Khan leaves Big Boss, will you be interested in watching? Still watch. You don't watch now also. Good. I'm happy to hear that. It is not worth watching also. But the brand value of that program will certainly go down. Okay. So therefore, the anchor investor is important. Prabhat Dairy, one example of a company where there was a issue in the pricing. Offer failed to draw anchor investor as the price was at a sizable premium to the listed peers. and there were challenges in growing the business. So anchor investor did not support. Then in case of AdLabs Entertainment IPO also, AdLabs, I think this is that Anil Ambani group company, yes or no? And they are into movies. Anchor investor have bid at the lower end of the price band. In the public issue which opened a day later, poor retail response forced the company to lower its price band to get subscribed. So that is why anchor investors are important. But again, it is a part of SEBI guideline. SEBI has issued some guideline for anchor investor to protect the interest of company, protect the interest of the other shareholders also. Okay. So you will find some guideline here now. First is the anchor investor shall make an application of a value of at least rupees, underline 10 crore in the public issue. So they have to take a risk of 10 crore rupees, at least 10 crore, which nowadays is not a very big amount because public issues are now in thousands of crores of rupees. So when you put your own money, you are more serious, more careful. That is why this 10 crore is there. It's not a small sum also. An issuer can now allot up to 60% of the shares reserved for QIB to anchor investor. Not 60% of the entire issue. 60% of the portion which is reserved for QIB. Okay, so for example, if QIB portion in an IPO is 50%, 60% of 50%, anchor investor can buy up to 30% of the IPO. Now tell me, if suppose a company wants to issue 1 lakh share, how much maximum share the anchor investor can buy given this data? 50% is reserved for QIB, 50,000. Out of 50,000, 30% can be 60% can be purchased by the anchor investor. So 60% of 50,000 means 30,000 share can be purchased, subject to a minimum value of rupees 10 crore also. So that also you have to keep in mind. 1/3 of the anchor investor portion, again here one condition, shall be reserved for domestic mutual fund. You should not issue entire share to foreign company. Okay. So 1/3 will go to domestic mutual funds. The bidding for anchor investors shall open 1 day before the issue opens. Just 1 day before they have to complete this. Anchor investor will pay at least 25% margin money on application. Underline 25% margin on for anchor investor. For qualified institutional buyer other than anchor investor, it was 10%. For other normal investor, it is 100%. And balance has to be paid within 2 days of the date of closure of the issue. So it will put a lot of pressure on them and only serious candidate will participate. Why do we charge money from anything for anything? Only serious candidate will participate in that case. Is it right? So allocation of share to anchor investors shall be completed on the date of bidding itself. Tick mark. Same day the shares will be issued to them. In 1 day the whole thing gets over, except that the remaining 75% payment will be collected 2 days after the closure of the issue. If the price arrived at after the book building issue is higher than the price at which shares were allocated to anchor investor. What is the cutoff price? 225. What is the price at which shares were allocated to anchor investor? 210. Bring 15 rupees. So then in that case situation, anchor investor shall bring in the additional amount. Reverse will also happen. Suppose the price arrived at after the book building process is lower. Book building process price comes to 205. Anchor investor has paid 210 rupees. Excess will be refunded to the anchor investor. Will be refunded. that accounting adjustment can be done. Either you refund it or you adjust against the amount due. Okay, doesn't matter. Now there is one condition here. Anchor investors shall not sell their share for a period of 30 days because we are giving them preference. So they should hold the share for at least 30 days from the date of allotment, as against IPO investors who are allowed to sell on the listing day. So this will protect manipulation. This will prevent the interest of the shareholders. So if you want to become anchor investor, there is a 30 days lock-in period. Otherwise, you become a normal IPO investor and then you can sell it the moment the shares get listed on the stock exchange. And lastly, the merchant bankers or any person related to the promoter group or merchant banker in the concerned public issue cannot apply under the anchor investor category. So related parties are not allowed. Now there is a case study of Interglobe Aviation Limited, which is popularly known as Indigo Airline. Now this Indigo Airline had also used anchor investor. So that whole story is printed there. I will just read it fast because there is no question here. It is just what happened in the Indigo Airline regarding anchor investors. Okay, so you will also just quickly read it. Do not lose your time and sleep on this case study. Interglobe Aviation Limited, owner of one of India's most profitable airline, Indigo. Huh? Only profitable airline. Yes. Received demand for around 8 times the share it offered to so-called anchor investor, including domestic and foreign institutions, a day before the start of the IPO. 8 times they received the demand for the anchor investor portion. The company raised rupees 832 crore via the anchor investor allocation, also known as anchor book, selling shares at rupees 765 per share at the upper end of the rupees 700 to 765 price band. So what was the price at which the shares were allocated here? On the highest band, 765, because that got so much of demand, as it was the only profit making airline. The company intended to use the proceeds of the fresh issue of shares primarily to retire its aircraft lease obligation. What was the objective of raising money? To retire their aircraft lease obligation, because earlier the aircrafts were on lease and they have to pay huge lease rental. Now they purchase. It utilized rupees 1165.66 crore to retire some of the existing aircraft lease obligation. The company will utilize rupees 34.25 crore for purchase of ground support equipment for its airline operation and the remaining amount for general corporate purpose. The anchor investor include, now some anchor investor names are mentioned here, among others, Harvard University Endowment Fund, US fund, Goldman Sachs Group, again a US company, this I don't know, Ruan Cunniff and Goldfarb Inc., maybe US company, Fidelity, BlackRock, Dutch Pension APG, GIC Pte Limited and Singapore Sovereign Wealth Fund. This is the Singapore government itself who also invests. Okay, that is called Singapore Sovereign Wealth Fund. All these big names in the field of finance, they acted as anchor investor. Domestic investor included HDFC Mutual Fund and Sundaram Mutual Fund. The IPO of the Interglobal Aviation Limited is one of the largest anchor books for an Indian IPO, and over 40 investors have subscribed to it. So how many anchor investors were there? 40. The demand for the main IPO was very strong, because obviously if you have so many people already supporting the issue, the demand goes up. Before the issue date and given the names of the anchor investor, retail investors have also attracted to the issue. Interglobe is seeking to raise rupees 3,000 crore from the IPO, including the anchor book. Indigo had a total debt of 3912 crore as on 31st August, all of which was aircraft related. The company intended to use the proceeds of the fresh issue of share primarily to reduce the aircraft lease obligation. It utilized 1165.66 crore to pay some of the existing lease obligation. I think some lines are getting repeated. Go to the next paragraph. Private placement of share. Private placement, did we come across? Means, are we issuing shares to public or to selected institutional investors? Selected institutional investors. As the name itself suggests, it is the process of raising capital directly from institutional investor. In your book, there are some paragraphs which are getting repeated. A company that does not have access to, now why will company go for private placement? Sometime a company may be a new company. General public may not know that company. Okay. General public may not be aware about that company's working, management, product. So what they can do, or they may not want to go for IPO also. Or they may not want to go for IPO also. That is also possible. Or does not wish to make use of public capital market. Many companies do that. IPO means you have to give lot of disclosure. Lot of information has to be shared with the public. Some of them are important business secrecy also. So they may just go to private placement route. Can issue stock, bonds or other financial instrument directly to institutional investor. So institutional investor can be mutual fund, pension fund, insurance company, large bank and some more. You can approach them. Private placement means any offer of securities or invitation to subscribe security to a select group of persons by a company other than by way of a public offer through issue of a private placement offer letter. So you have to first give them a private placement offer letter which satisfies the conditions specified in section 42 of the Companies Act. Have you heard such section? When? It was there in intermediate. Of course it should be there. It is issued to a selected group of persons. The proposed offer of security or invitation to subscribe security needs to be approved by the shareholder of the company by way of special resolution. Why special resolution? Because many shareholders' interest will get diluted. Okay. From a majority shareholder, you may become a minority shareholder. From a shareholder with significant influence, now it will be just 5 to 10% after that whole process is over. So therefore, you have to take the approval of your shareholders and that to special resolution every time for each offer or invitation. Now there is a question, why private placement of shares are frequently resorted to by the companies? Or the question can be, what are the advantages of private placement? Okay. And then below that there is a case study on private placement also they have asked. So mark important because there is a case study question which they can ask you in the exam again. So advantage is, one, it bypasses the stringent regulatory requirement of a public offering. True or false? Yes, because public issue means long list of regulatory compliance. And management may not have so much of time, energy, and they don't want to give so much disclosure to the public. Why to expose yourself to public scrutiny? Yes or no? Even if you become a listed company, you have to file with SEBI, stock exchange, ROC, then shareholder, media. Everybody will scrutinize your results because you are a publicly listed company. And therefore they prefer, okay, let us remain closed group. public offering must be done. In case if you want to go for public offer, as you have read in the last so many pages, you have to follow SEBI regulation. For private placement, company needs to comply with Companies Act, and they do not have to register with SEBI. When I will go to SEBI? When I have to raise funds from the public, when I have to get myself listed. Private placement are negotiated privately between investor and the issuing company. Call the investor in your office, give them a presentation about your company, tell them this is what we want for this much take. Are you interested? If they like, they will pay the amount. They will take a checkbook, write it. Done. Yes, it happens like. So that is my point number E. In your book, it is point number E. Reduction in time of issuance. You don't have to prepare draft prospectus, red herring prospectus, etc. Just sit across the table, negotiate. And the cost of issuance, no merchant banker fees, underwriter fees, may be there, but relatively much lower. No drafting of prospectus, issuing prospectus. Issuing security publicly, means public issue, can be time consuming and may require more expense. Private placement foregoes the time and cost that come in a public offering. So these are the advantage. Next is also become, because private placements are negotiated privately between the investor and the issuing company, they can be tailored to meet the financing needs of the company. Okay, tailor-made negotiation can be done and the investing needs of the investor. Suppose you say I need 30 crore now, 40 crore after 1 month, 60 crore after 1 year. Accordingly, they pay in tranches. Is it right? So you can discuss terms and conditions. This gives both parties, the company and the investor, a greater degree of flexibility. Now the question below, case study, is nothing but in the form of a case study, they are asking you which is better, public issue is better or private placement is better. And in the exam, you have to just write the advantage and disadvantage of both the public issue also and the private placement also. So this is how they will frame a question in the exam. A good sample question for you. Springer Limited is a US based company and is famous for manufacture of electric appliances. This they must have copied from some foreign author's book. Okay. The board of directors of Springer Company decided to expand the company market area and decided to enter new market such as India and other South Asian countries and Latin American countries. They decided to incorporate a company in India named Springer India Limited. Springer India Limited decided to raise money from Indian market. Company has two options: to raise money through private placement or from public issue. The question that the student has to answer in the exam for say 20 marks, followed by many other questions of true, false, fill in the blank, small question, which may not be related to the above case study. I have told you on the day 1, entire 50 mark is not related to the case study given in the problem. Some questions may be just other chapter direct question. Evaluate the two options available to the company and give your report containing the comparative of advantage and disadvantage of both the options so as to enable company to take the appropriate decision. So what is the role of the consultant here? The consultant are you. You have to put all the advantage, disadvantage in front of that company, and then the company will decide what is better for them. So what the institute is trying here, to check your basic knowledge about private placement and public issue. Answer is also printed and you will find it is a complete repetition of the previous few pages. Okay, but how to present the answer? let us go through it from that angle. How to present a case study answer. So you have to write questions raised in the case study on private placement has been answered in the following points. So you will first write down in the exam the meaning of the two types of issues. First you will write what is public issue, what is private placement. Okay. So public issue means the sale of equity, shares or other financial instrument by an organization to public in order to raise funds is called public issue. Any offer to more than 200 people in India is called public offer. In India, public offer is governed by SEBI. So this you have to tell the foreign investor that if you want to go for public issue, follow SEBI. When a company issues financial securities such as share or convertible security to a particular group of investor, number should not be more than 200. Then we call it private placement. So you are first telling in the first few paragraph what is public issue, what is private placement. Any offer of security or invitation to a selected group of person by a company other than by way of public offer through issue of private placement offer letter and which satisfies the conditions given in section 42. Have you heard section 42 of Companies Act? It deals with private placement. So what they have done in point number 1 and Roman 2, they have told the foreign company that this is the meaning. Understood? They will say yes, we have understood. Then you tell them advantages and disadvantages of both. So 4 more paragraphs quickly. Advantage of public offer. Even in your interview, once you qualify and want to join some merchant banking company, investment banking company, this question they will ask you during your interview, that why public offering is better than private placement. You should say you'll get more fees. Okay, don't write that. Company will raise a large amount of money because who can invest? The whole country can invest. Whereas in private placement you have maximum 200 investors. So there is a limit on the number of investors. So there is a limit on the amount. This is because anyone who can afford to invest can purchase the stock through a broker. Next is shares are highly liquid because they will be sold in the secondary market. It is easier to attract the investor. Investor as an exit route. Okay. And the third is there is a prestige in an IPO. There is a prestige in an IPO because you will say that we are a listed company and therefore your company will be exposed to a large number of people also. You get a lot of publicity. People in general know about your company, which otherwise in private placement may not be possible. Because you'll get a lot of media coverage. It will come in the newspaper. It will come in the television. Mobile phone also. Okay. So people get to know about the company's products and services also through IP. But there are some disadvantages. Paragraph number Roman 4 in your book. First, it takes a lot of time. Second, which people don't like, and that is why there are not so many public issues in India. Regulation. You have to comply with tough regulation of stock exchange, SEBI, etc. Okay. Indians are not very good in compliance with regulation. Yes or no? Are you? No. You will find some or the other ways to bypass the regulation. Next is advantage of private placement. Cheaper and faster. You just have to deal with some selected investor. You don't have to go through that long lengthy procedure of public issue. So cheaper and faster because that commission, fees, printing, stationery, administration, legal fees, all those will also be substantially reduced in private placement. It will be there but much lower. If that costs you 8 to 10% of the total fund range, this may cost you 1 or 2%, 3%. Companies that sell equity through a private placement face fewer reporting requirements. Compliances are less, so fewer reporting requirements, so less compliance. And third line I have written in your book, with a private placement, it might be easier to decide to whom owners sell equity. You can choose your investor. You can choose your investor. Who should invest in your company? And then why companies follow private placement in India? Last line. Certain key information can be kept secret. Business secrecy is important. But the disadvantage of private placement is that you will have a narrow range of investors. Few investors only. Is it right? Because you will invite only limited set of investors. So you will not be able to reach a large group of investors. Some management may be comfortable with that. Less investor, less headache. Yes or no? But these are sophisticated investors. They will continuously ask you questions because they have huge money invested. Few investors have invested large money. So in fact, they will trouble you more also. Do you know that? If somebody invests 10% in your company, he is not going to sit silent. 10% in a company is a big amount. So they continuously chase the management about their function. But anyway, now how do you look at it depends on you. You want few investor or more investor. And why private placement is not good? There is a limitation on the amount of funds you can raise. Because you cannot invite more than 200 investors. And if you need a huge amount of money, probably this investor will not be able to cater to that huge amount of funds as compared to a public issue. Okay. Then next is, this I have read. Yes, in case of private placement, exit route is difficult, right there. Exit route, because we are actually looking at the question from company's point of view, and that is why that line is not there. But if you still want to write, exit route for investor is difficult. Yes, your query. Yes. Normally they enter into a shareholders agreement, okay, in such cases. And in that shareholders agreement, they may list down that after 5 years, our stake will be purchased by the promoter at the certain price, which again they will negotiate at what price. But that again may or may not be there. It's not applicable to every private placement that there must be an exit route given to the investor. It's all negotiation. Okay. Unless there is a specific law about exit route, it's always a matter of negotiation. Now we'll come to one paragraph which is called disinvestment. Disinvestment word is usually associated with government. Government has lot of investment in public sector companies. When India was independent, got independence, there was not too much of industrialization. There was not too much of big companies which will produce goods of mass requirement, infrastructure. To that time, the government, or Congress government, Jawaharlal Nehru, they said that we should create PSUs. Large PSUs we will create, which will meet the requirement of the country for rapid industrialization. Okay, the idea was good. But do we still require such large PSUs after 75 years of independence? No. Now the private sector has become strong. It can undertake any responsibility of commerce. Yes or no? It can manufacture cars. It can manufacture anything that you need, including the defense equipment, trucks, okay, ship, banks, they can run. So why do we need public sector? So slowly and slowly what the idea is coming into the government mind. that government stake in this PSU should be reduced. Let them also run on the competitive manner. So in 1992, when this Congress government came, in that liberalization policy, one of the aspects of liberalization policy was to reduce the government's role in running of businesses also. And during this period of Congress, this investment was carried out, okay, on a mass scale. It will help the government to raise the funds also, which they can use for other development purpose. It will also get the chance to government to come out of the loss making PSUs. Like there is a chance that Air India may be fully disinvested or majorly disinvested, as it is a loss making company. So it is eating away the funds of the government. Public money is getting wasted, okay, in loss making PSUs. So that is disinvestment. What are the objectives of disinvestment program of the government of India? One is to raise the funds to finance the fiscal deficit. So government needs money. What are the sources from where they can raise money? First, they will tax you as much as they can. As long as it does not cause civil unrest, they will tax you. Okay. Then they will borrow money. But again, there is a limitation on that also. Then they will print money. But again, RBI is involved there. So there is a limitation on that. And then they can also sell the stake in the PSU to raise the. This is also one trick that they use to raise funds and reduce the fiscal deficit. Fiscal deficit, in simple words, difference between inflow and outflow of the government in a year. Inflow, outflow. Outflow is expenditure. At the same time, to retain the control over the management also. So recently you will see Coal India Limited, NTPC, ONGC, they are all listed, where government is reducing their stake but not below 50%. So control is also there. At the same time, by diluting some stake, you are able to raise the funds also. One statistics I have read in the newspaper, if you sell all PSUs, India will not be required to pay tax for next 10 years. Both direct and indirect tax. For 10 years will become tax free. If we sell all PSUs, so much money you can raise. But will not do that. Third reason for this investment is to improve the management of PSU, because now what will happen? Private sector will come. They will run the company. So they will try to bring more efficiency. To broad base the equity. To broad base the equity means different types of equity investor will be there in the company. So more corporate governance will be there, more accountability will be there. And the next is to increase the availability of resources for this. So these are the objectives of this investment program. The idea is that government should move out of the running of a business. Earlier there was a modern foods also, which to manufacture breads for public. Is it the business of the government to make usual daily use bread for the public? No. There is an ambassador car company also, Hindustan Motor. Now they have closed down. Air India. Will the government run Air India? Is it necessary to run companies like Air India by the government? Not necessarily. If you run it profitably, efficiently, okay. But otherwise you get out if you don't have that expertise. So that is the reason. Why it is not done in a big way in India? You know the answer. Politics. Is it right? Vote bank. Now I don't know why they have inserted right issue again in this last few pages. Already covered earlier. Right issue means share issued to existing shareholders in the certain proportion. The only extra thing which they have added here is conditions of right issue. Section 62 of the Companies Act 2013. What it says? where at any time a company having a share capital proposes to increase its subscribed capital by issue of further share. समझ गए? You want to increase your share capital by issuing more share. First priority will be given to existing shareholders. Such share will be offered to persons who on the date of offer are the holder of the equity shares in proportion as nearly as circumstances admit to the paid up share capital on those shares by sending a letter of offer. Underline what is sent here to them, not prospectus, letter of offer, because they are already the shareholders of the company. Every year they are enjoying the annual report of the company, they know what is happening. Subject to following. Now what are the conditions? The offer shall be made by notice specifying the number of shares offered. So normally you will get a letter from the company. Nowadays it comes on your email account. Earlier they used to send a hard copy. Okay. And it is mentioned that you are eligible to subscribe to so many shares and limiting a time. There is a time limit given, not less than 15 days, not more than 30 days from the date of the offer, within which the offer, if not accepted, shall be deemed to have been declined. If you don't take any action till 30 days are over, it is assumed that you are not interested in purchasing the share. However, there is one more thing that they do. You don't want to purchase the share, you can sell it to others. That facility is also there, unless the article of the company otherwise provide. If articles put a restriction, then you can't do that. The offer aforesaid shall be deemed to include a right exercisable by the person concerned to renounce the share offered to him or any of them in favor of any other person. Rights can be transferred to other person unless it is prohibited by articles. And the notice referred to in the clause above shall contain a statement of this right also. So actually that letter which you get from the company, I have seen that letter, it had come to me also some years ago, contains two paragraphs. One says you can exercise. If you want to exercise, fill the left side of the page. Second, right side says, they say if you don't want to exercise, you want to transfer it to others, you fill the right side of that page, so many paragraphs, write the name of the party to whom you want to transfer, etc. After the expiry of the time specified in the notice aforesaid or on receipt of earlier intimation from the person to whom such notice is given, either the time will expire or the person will notify that he declines to accept the share offered. What will the board do? Suppose person does not want to exercise, does not want to renounce in favor of his friend. Board has been given a power to dispose them of. Then this share will be sold by the board in such a manner which is not disadvantageous to the shareholder and the company. The notice referred to above shall be dispatched through registered post or speed post or through electronic mode. So email. Can they send on WhatsApp also? No. WhatsApp is not an electronic mode. For that time being, no. Or to the entire existing shareholders at least 3 days before the opening of the issue. Okay. So now we will continue tomorrow.